Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm glad to have with me once again Michael Oliver. And Michael is a regular guest on this show, so I'm not going to read his bio, but it is available at the Voice America Business Channel on my radio show page at the Voice America Business Channel. Go there and check him out. But also what I would suggest is you go to olivermsa.com, Oliver, M as in Mary, S as in Sam, A as in Albert.com. Go there to learn more about Michael and his work. In fact, that's probably the place that you should really go to, and his bio will be there. You can learn all you need to know about Michael. Thank you for joining me again, Michael.
Great to be back, Jay.
Always good to have you. In your weekend missive, I should say, you noted that all manner of markets and all sorts of, I think, the Forex, the commodity, the debt, and the equity markets have become increasingly volatile. In fact, we saw, I think, something more than a 6% decline in the Chinese markets this day. Yet, you note that the U.S. equity markets have been enjoying a fair amount of tranquility. Most people would say, well, that's good. I mean, this is the reason that you should put everything you've got into the U.S. equity markets. It's the only safe haven in the world. But your thoughts are not necessarily along those lines, whereas you're not really expecting a dramatic plunge necessarily. You're sort of thinking that maybe people should start to be rethinking things. Is that right?
Yeah, I think the volatility metrics are important. There, of course, is the very popular VIX index, which is used against various assets, including the S&P 500. There's even contracts. You can trade options. You can trade against it. It is a metric that measures volatility via the pricing of options against the S&P 500. So it's an option pricing implied volatility measure of volatility. I do something different. I measure volatility via momentum, standard deviation bands of momentum readings, and now momentum of price. So I come up with volatility readings that sometimes will tend to be coincident with what the VIX index is saying. Oh. However, there's a distinct difference here. Over the last 3 years, the VIX index for the S&P 500 has recurrently made lows at 11 and 12 points, very, very low levels for it. Normally, when you get extreme complacency, very low levels of volatility, it means the market's vulnerable for the downside. Meaning the investors are so confident they're not even buying puts and calls. Everything's great. But that's been the case for 3 years in the VIX, and yet there's no drop in the market. Which says we've stretched the reality of that metric almost beyond the beyond. My metrics, however, did not get to levels that indicated extreme complacency until last September. So we're talking like 10 months. So, once we got there, what happened the next month was we had the October mini crash. The S&P dropped a couple hundred points. Remember, from 2,000 down to 1820. Now that recouped, came back up, and now I've got volatility readings again via momentum back down toward the levels where they were in September of 2014 again, at extremely low historical levels. Now, if I go back 90 years using this same metric, volatility of momentum, and I find readings this low, it almost invariably links up to a major top. Now, I won't say it's a wet noodle indicator. It's not something you say, oh my God, let's get short. You might be 3 months off either way. But it generally is a very dark cloud. Now, what I've noted in the last few years is the foreign exchange markets, for example, a year and a half, 2 years ago, were extremely dormant, far more dormant than they normally are throughout history. Dollar index would barely move, the euro would barely move, and therefore I had volatility readings that were just, like asleep. And therefore, based on that, I forecast that, one, I was looking for the dollar to go up, but two, a volatile upside. And so we got that. Now, it wasn't correlated month to month, but it was in general, it said, watch out, the foreign exchange markets are going to come out of their sleepiness, and that's the biggest market in the world, after all, and get violent. So one of the big markets that was asleep got violent, sure enough. That's the euro went down, yen collapsed, dollar went up big, so forth and so on. There is no major market category in the world right now, other than the U.S. equity market, that is asleep. Therefore, I think the U.S. equity market volatility is going to increase, and I do not think the volatility will convert to upside in price. I think we'll convert to downside. Mm-hmm. The question is when. Right now, next month, the following month, soon, I think.
Mm-hmm. Mm-hmm. All right. Soon is a relative term.
Mm-hmm.
And soon means, I don't know. I guess what you're doing is you're looking at probabilities on an ongoing basis in your own mind.
That is a cloud indicator. It's something that says there's a dark cloud over you. Now, I go to more specificity on trigger numbers, and I've got one, and it's my final trigger number, and we didn't hit it this month. We missed it by 3 points. It's 2041. We went to 2044 low. Next month, that number is going to jump to 2062, approximately, is my estimated new number. So if the S&P tags that number next month, and it rises about 20 points a month, I expect that all the topping action that I've recorded and measured in the momentum work will finally bear fruit, and it will finally capitulate, and therefore increase its volatility, and therefore join the crowd of other assets that are in extremely volatile nature. So the S&P now is the only one, and it's the only one in the equity markets as well. I mean, you can measure Europe. I measure the DAX index, for example, or Shanghai, extremely volatile. You know, they're totally in sync with the volatility of the foreign exchange markets, volatility in gold, volatility in debt markets. It's the S&P 500 and a few blue chip indexes in the U.S. that are asleep like a little mouse, you know, and I think that's going to come undone. I don't think this will last much longer, and I think it will correlate into a downside market.
Well, so I guess people are seeing the U.S. markets as a safe haven, but, you know, Michael, when I'm looking at the S&P 500 right now, it's at 2096. Not all that far from 2062. So
That's true. No. It seems to know where to keep its toes from touching, though. I've noticed that over the last several months. Anytime I come up with a final number, it'll come down within 2-3 points of it and say, not now. So ultimately, though, it doesn't seem to escape, really. It just seems to avoid breaking down. It doesn't really take off. It just says, I don't want to jump now. So I think it's on the ledge, and I suspect that within the next 4 weeks or so, we'll see some action on the downside.
All it needs is a little gentle push, perhaps.
A gentle push, yes.
Yeah. So what? I guess when people look at these markets that are extremely tranquil, low volatility, stable to up, and when you see that for a protracted period of time, I mean, we've had a 7-year bull market here. I guess this is pretty protracted, isn't it? This equity market too. It's long in the tooth, as they say.
Oh, there's no question, it's long in the tooth, and there have been some prior examples of this, and it's not uncommon if you just reference price charts, for example.
Yeah.
Go back and look at 1937. Go back and look at 2000. Go back and look at 2000 to 2008. There were a lot of months spent going lateral with a steady, confident tone.
Yes.
No real gains, just, hey, I'm up here and I'm fine, and, what me worry. And so this protracted, slow, stagnant, low volatility topping action is not uncommon. And I think that's what we're going through right now.
Well, that's certainly the tone you get when you turn on the major media, for sure. And, again, it gives some examples then, I guess you just named some then, in which we've seen these protracted periods of time. So what are you thinking? You think we're pretty much close to the bottom? Your readings are telling us in oil right now, WTI, I saw this was closing in earlier today on about $40 a barrel. You think we're getting pretty close to the...
I think we're getting close. I don't expect a dramatic surprise here. I think the dramatic move already occurred, and most people missed it. That was the collapse last year from $96 down to in August, and by March of this year, you reached near 42. I mean, that was it. If you're looking for another one of those, forget, not going to happen. Now, can you falter on down and take out the low? Sure, and we just did. In this past week or so, we took out the March low at 42.03. We dropped down in the 41s. I'm not confident one way or the other whether we're going to break 40. I don't think it's relevant. I think that most of the factors that I needed to see build a basing pattern have now begun to do so, and this drop is part of a basing pattern. But my near-term to intermediate term trading type indicators say beware of the potential for a very sharp oil upturn here. Now, I don't mean one that's going to take you to $70, but going from the very low 40s back up to 50 could be something accomplished in a few weeks. And I see the technicals ready for that. I think that's all part of, and remember, oil's a lag commodity. It's not a leader. It's the dog at the end of the rope. Gold already collapsed 2 years ago. Soybeans, corn, all that. Those are history. So oil was the last headline negative commodity, and it's the one that got all the negative sentiment built up about how commodities are going to keep going down, which I don't buy into. I think commodities are bottoming. But I think that oil is even near levels now which it could start to turn from, and I'm not at all unsure whether an upturn now could be, in fact, the final low. It could very well be that we're making a final low. Now, whether we drive out of here in a sustained way, I doubt that, but easily $5 to $7 rally in oil could occur in the next several weeks with very little nudging to the upside to get it generated. I think that would also correlate to some other commodities having a bounce, too. And funny as it seems, I think that could help the S&P 500 get a little boost.
All right.
Because there are enough commodity oversold sectors within and symbols within the S&P that if they got enough wind in their sails for even 2 weeks, it can help keep the S&P afloat. So then all the other sectors just, pick their teeth for the next 2 weeks.
Right,
so, anyway.
Well, that's interesting. Okay, well, just with a minute left here, what about gold? What are you seeing there?
Gold,
are we, us longs?
It's had a 5% rally from its low almost, from its intraday low of several weeks ago to the recent high. It's clipped some of my second tier level of buys. So if I were long gold, I'd be long 50% of whatever I might wish to have on as a position.
Okay.
The next level that I would really pay attention to is I've got a zone from the 1140s up to the low 1160s. If you ever cleared that zone, that's the third level where I would add on the next 25%. Now, that's above us, but it's not that far above us.
No, it's not.
The final level's up in the low 1200s. But so far, I think gold is behaving, and unlike the continued drop in commodities, nobody seems to note that gold's 5% off its lows.
Yeah, that's true. So we have a lot of people that want to see gold continue to go down because that's an indication to everybody that everything is fine and dandy in the hearts and minds of many people. So there is definitely an anti-gold bias. I think we've been brought up to think that way. But in any event, there's, the bias is what I do appreciate about your work, Michael, is that it's, you take the emotions out of it, right? And you're looking at what the markets are telling you, deciphering what the language of the markets, as Richard Russell used to like to say. And I really always appreciate you coming on. I want to thank you again for being with me. And, of course, whenever we can find some time to have you on, we want to do that. So thanks again, Michael.